Konnichiwa, everybody. Welcome to the Flow Show. Morning, K-Man. Still awake?
Ohayou gozaimasu. Yes, still awake. Well, just. We're getting too old for those cut-up nights, mate. Well, I am anyway. Yeah, we are still awake. Still rocking and rolling. Friday. Nothing happening for the rest of the day. You know, we can just snooze. Or can we?
Or can we? Yeah, I think if we're going to snooze, we have to snooze at a desk with a lot of alarms going. But anyway, right, obviously the big event was the Bank of Japan. We'll get to that. We'll talk about that last today, I think. Get through some of the other news headlines. ECB's Panchetta says we must weigh the risk of monetary policy becoming too tight. Timely and small cuts would counter weak demand and could be paused at no cost, while large cuts could create a credibility issue. It's going to be a credibility issue, whatever they do. ECB had a survey out, consumer expectation survey out for inflation. 1 year inflation dropped a pip to 3% from 3.1. 3 year inflation expectations stayed unchanged at 2.5. Yesterday's data in the US, I think this might have gone a bit under the radar. Jobless claims came in a little bit stronger than we've seen of late, a low 207k, and continued claims still going lower in the 1.7 million. So that's still looking pretty good. GDP now. We're going to have a discussion about GDP, or a quick discussion about GDP. The market got its knickers in a twist because it came out 1.6% missing expectations. So everyone started screaming, here we go, here's the turn, US is collapsing, this is what we've all been waiting for. Okay, context, it was still a gain, it just missed expectations. Okay, it's still posting growth better than a lot of other countries. Okay, it might have had a wobble, it might be something, but it might not be something either. It's still a positive number. If that growth came in negative, then people have got something to squawk about. What was hot was the Q1 PCE numbers, and they've been now extrapolated over to what we're going to get from the PCE today. So by all intents and purposes, we should be expecting a hotter number than expected. The number's expected to rise in one or t'other of the components, PC and core, but we might be looking, the market might be setting its sights a little bit higher after that PCE data. So we need to keep an eye on that. We've also got a few other bits and bobs. Trade balance was a bit worse, 91.83 deficit on there. We had some inventory data, wholesale inventories posting a negative. Now that can play a bit into GDP if inventories are being used up. That can tend to mean that their activity is slowing because no one's ordering new stuff. They're just going through stock. Pending home sales as well came in positive on the month, up 3.4%. So nothing really to worry about there from that one. So after the market had a little bit of a flip out on the GDP data, it recovered. We saw Fed swaps no longer pricing or fully pricing a rate cut before December for the Fed. Now, obviously, we have the FOMC next week, so we're going to have to wait a while before we find out what these guys think about the recent inflation data, GDP and PCE, which we're obviously getting today. Treasury Secretary Yellen says GDP data shows strength in the consumer and investment spending. We know this, but says there could be revisions to the GDP data. Obviously, they're going to have another 2 goes at getting it right. Says no doubt housing's contribution to inflation will be coming down this year, and not seeing signs that wage pressures are a source of inflation. Says we have a very good, strong job market, and we're not seeing evidence the labour market is a source of inflation. We certainly don't see the US economy as overheated. And then a little nod to those guys in Japan, says believes currency intervention is acceptable only in very rare and exceptional circumstances. Kay, just talking about the US data yesterday. It's not panic stations, is it?
No, well, I wouldn't say so. And the market clearly didn't know what to do with it. Trade the weaker GDP or trade the stronger prices. In the end, looking at the dollar overall, it's more like on the weaker GDP forecast train, but then just um, I no, as you were saying, I mean, we are going to get at least 2 or 3 revisions, right? They came in below what the Atlanta Fed now cast is, but we know they revise every other day. It had those Q3 vibes. Q3 last year in the US was also expected first to come in around 1.5, 1.8, and then finally it came in, what is it, above 3% or so, or 5%, 4.5% or so.
Yeah.
So nothing is done over there. But as we say, we are data dependent, so the market reacts on data. And that's it basically. I'm not going to start to overthink those numbers. What we do see is that the prices remain stickier than expected. Actually jumping quite a bit if you look at the core PCE prices there. Yeah, that doesn't bode very well for those who would like to see inflation come down for this afternoon. This being said, this afternoon, usually that data point is so well documented and expected and has had already so many hints at it that it should not come out too far from expectations, right? So, but I'd say, as usual, and this is just what the market likes to do, I'd say the surprise would be a weak one, and then the market is going to grab it with both hands and trying to slap the dollar, in my opinion. But that is just how the market's mood is most of the time.
Yeah, we can see there if we just go back pretty much a year, it's usually very tight with expectations, as you can see there. So, yeah, we have to see. As I said, it's expected. Well, the core is expected to come down to 2.6%. That the market's probably sitting a bit higher than that.
Yeah.
And the main PC is expected to jump a pip. So one up, one down. This one is the important one. So, yeah, it's going to be an interesting one anyway.
According to the data that we had so far, it would not be a surprise to reprint the 2.8, right? But as I said, I mean, coming at 2.5, all of a sudden the market is going to go, well, all right, this is the end, and let's buy bonds en masse and sell the dollar a bit. If that, well, the dollar, I mean, all dollars barring the dollar yen, of course, that's a different story.
Yeah. And I think it was ING, James, put in our chat room yesterday, talking about the quarterly PCE numbers and how that will affect the monthly numbers. 3.4, 3.2, 3.40, 3.42 would have been, a 0.3, 0.2 on the monthly on this number, but it's coming at 3.7. So, by all rights, if ING are right, this should be well higher. And that's going to be a big feature as well. But who knows what this data's like? Everyone was expecting a high GDP and got a low one. So the numbers will be what the numbers will be. We can't do anything about it, but react to them when they drop. But at least we have half an idea what's expected from that. Right, let's get into it. The old BOJ. Right, where do we start? We start with that Tokyo CPI data. Let's get rid of that, which was a bit of a stinker. Big, massive drop. All of them down through 2%. That's a really big, blasting miss of expectations and a big drop versus last month. Now, we had this thing in that I put in the chat room yesterday from Morgan Stanley over there saying that there might be a wonky print for this CPI because tuition fees in Tokyo have been pulled out and scrapped. So that's dropped out the index. I don't know. Me and Kay, while waiting for the BOJ, we're going through the data yesterday and we couldn't find anything really that ties that together. But then the data is huge. It's a huge data set. So trying to find out anything is a bit difficult. I don't know, Kay. This seems a bit big just for pulling out one little subcomponent. But the yen didn't move on that at all, really.
Oh, it didn't, because everybody was just waiting for the Bank of Japan, really. But it may have helped in having that delayed reaction that we saw then after the Bank of Japan. Yeah, it is a significant drop. We did find those education numbers coming down, right?
Yeah.
We spent, what is it, an hour or so before the Bank of Japan trying to figure out which lines to find in that report.
What else are you going to do 3 o'clock in the morning?
Whereas that's getting crazy. But anyway, kept us busy. So we did find this education thing, and the price of horse mackerel, cucumber, and I don't know what else was coming
Pumpkins.
down as well. Which is good news for the people liking sushi and other
Pumpkin katsu, yeah.
Yeah, it was a big drop, and quite funnily, not been mentioned at all in today's Bank of Japan stats, right? Or not even Ueda touching up on it, unless I missed something, because he's still relatively confident that they're on their way, but not yet there. He still lacks a bit of confidence that they're going to be printing lastingly the 2%. And if you look at the Tokyo CPI, is right to be in doubt. Yeah, that was a bit of a naughty one. The thing is, it better correct again next month. But if it is all down to tuition fees and education costs being reduced, if you look forward a month, unless well, the non-core things start to ramp higher, this is we could print another low one.
Yeah, and we'll see if maybe it's not such an impact in the national numbers when we get those in what is it, 2 weeks' time or something. Yeah, so definitely something to keep an eye on moving forward. Now we got some sources headlines from Gigi yesterday saying that the BOJ will consider measures to reduce its government bond purchases, which is obviously something that has been a hot topic in that, and that's round about one of the bigger headlines or notable headlines from that. When they dropped the announcement, they said they had dropped the wording on buying the same amount of bonds as before. Only it's one of their little subtle changes that still gives them optionality, but doesn't make it as specific as it was in prior statements. They also upped their 2024 fiscal year 2024 CPI to 2.8% from 2.4%. So that's quite a significant jump on that one. They upped their 2025 to 1.9 from 1.8. In the statement, they said they need to pay due attention to FX developments. They see the economy recovering moderately, although some weakness is seen. And inflation is to converge around the BOJ's target in the latter half of the forecast period. Straight after the announcement, Suzuki popped up to say they will deal with FX appropriately, but declined to say whether these Forex moves are excessive. And then we had to wait for Ueda. He came out saying we must pay attention to financial and market moves and their impact on the economy. Monetary policy conduct depends on future economic, price and financial conditions. The economic outlook risk of an overshoot may also be a reason for policy change. FX could be a vital factor to affect inflation. And if FX fluctuations affect underlying inflation, that could be a consideration for monetary policy. He said, although the main reason for the fiscal year 2024 inflation upgrade is higher crude price, the weak yen had an impact to some extent. He said the reduction of JGB buying in the future is in sight, but can't say or give a specific timing on cutting those. The chance of a prolonged weak yen is not zero. No shit, Sherlock. We can preemptively judge if a weak yen affects underlying inflation. Preemptively judge. That's quite a significant line. if it affects underlying inflation and the spring wage talks next year. The FX impact on Japan's economy does include positive ones. So overall, bit of a, it wasn't hawkish. I don't know how you'd call this one, Kate. Was it unhawkish? Not dovish, but unhawkish?
Is
Some
there
things were,
something?
the bond thing
Yeah,
was a
it's
little bit hawkish.
on both sides then, if you want. Yeah, it did leave the door open to reducing JGB buying, but at the same time, they also say that they kept their March plans right now. The interesting thing is, of course, in the future, because we have to know that. And yesterday, by posting something, I mixed up the yearly and the monthly in the trillions of yen that they have to do. My abacus broke down. So the thing, and I've already been saying that the redemptions are about 72 trillion yen this year, and in March they said that they would buy about 6 trillion yen per month, which covers the redemptions, the maturities in this fiscal year, but no extras. In March they said that they would buy more if needed. That means reading if the market gets a little distorted. That was still a bit of a hint, I think, at the 1% soft cap on the 10 years. That thing has been dropped right now. So that's the pretty much, let's say, the potentially hawkish thing preparing for a bit more to come. On the other hand, I think those yen lines are that was a bit of a strange one, because he does say that they can figure out how much the impact is. But on the other hand, he said that they haven't seen any material impact on inflation yet of this yen weakness. And that was really, I think, where Suzuki must have choked on his tea or sake today again. Because that wasn't really helpful at all. So that was the more dovish little thing that, well, not too little, that came out. So walking both sides of the aisle again, I think they're keeping their options on JGBs open, because he is still in cooperation with the government, so they can't completely stop buying JGBs. But it is worth noting that for a small portion during Q1 of this calendar year, they have not bought as many JGBs as there were redeemed, I think, to the tenor of 15 or so, or 15 billion dollars over the course of the 3 months, right? So that may be a hint that they are ready to scale it back a little further, that the government has to be ready to fund their stuff perhaps a little bit more aggressively. But we're nowhere near what Bloomberg wants to call the start of QT. I mean, that QT in Japan has we are nowhere near there. And I don't think that Ueda, not being the big reformer, is going to go in a full-on QT mode over there as well. They just can't. They can't afford it. They just cannot afford it. So, yep, walking both sides of the aisle and preparing for probably a little bit more. But the bigger risk of what I saw, so it wasn't the base case that we're going to do something, but the bigger risk of what I saw is to react to yen weakness. That's not been there, right? That we haven't seen that. We haven't got it.
Hello?
Yeah. Over to you, mate.
Sorry, I thought it was carrying on. Yeah, no, we haven't seen that. We haven't seen that at all. And that's obviously why we're seeing dollar yen making new highs in that. One thing with the QT, I think we know what they're like over there. They'll take the long, slow approach to everything. So I don't think QT is going to be a big deal. I think, if I recall rightly, one of the comments from Ueda was that their average duration on all their holdings is 7 years, which sounds quite low. They're not loaded up to the eyeballs on long dated stuff. So that's not rolling over 7. If they just stopped buying and let everything expire, 7 years would be quite quick for them to let all their stuff go.
Yeah, but that's somewhere also why they won't. And the thing is as well, because they are buying a lot more short-dated JGBs than the long end. If you look at what they buy in the 20s and the 30s, it's very small compared to what they buy in up to the 10-year. Let's say they're doing a lot of like 2, 5, 5, 7, and then the 10, and then afterwards the amount really goes down quite a lot, because they count somewhere on the insurers and the longer term Japanese investors to buy those JGBs as well, which they may, if we take another 20, 30 BPs here, they could start to really think about stepping back in more as well there.
Yeah, but do you think they're probably more likely just to let stuff roll off rather than actively sell stuff?
I think they will
So
continue
they keep
to buy.
that.
They will continue to buy, but maybe not as actively as they want. If they stop buying, and letting stuff roll off, then I think, looking at the Japanese debt ratio, it's going to be perhaps a least trust situation.
Yeah.
And Japan won't let it go. It's Japan. They won't let it go to that extent. They will not. I don't think so anyway.
Yeah, thanks, mate. Right, Ali, to answer your question, you should, if you've been following the show and you have been following the show long enough, you should know what intervention looks like. Intervention isn't a 160 pip move. It's 300-400 pip moves, and it goes and it goes, and you'll know about it. That move that we saw might be what we call a ring around, a check rates phone call, where they just put out a call to some of their banks asking what prices and whatnot. That can get the market on the hop. The only thing these days, and as Kay said, it's probably a regulation thing now. When they used to do rate checks, we used to hear about it pretty quickly afterwards. Reuters will pop up saying, there's been a rate check at this bank, or such and such source says BOJ have checked rates. We haven't had that, which is a bit. Yes, things aren't allowed to be spoken about due to regulations these days, but it was also a bit of an unofficial communication channel from those guys, because they would obviously ring around, but they'll turn a blind eye if someone wanted to drop that to the press, just so to let the market know. So I don't know. We're in this position where there's going to be a lot of nerves. Every 10, 15, 50 pips move higher, anyone who's buying it is going to get more and more nervous, and we're going to be susceptible to these types of moves. People spoofing the market, hitting the big bids, and everyone thinks, oh crap, here we go, and then everyone hits the sell button and in anticipation. So this is the higher the bigger it is, the harder it falls type thing. But where this is going now is anyone's guess. 160 is my level up to this area. Let's get on the old wide. 160 is the next main level for me. It's been previous area 160, 160, 20. I know Kay's got some stuff 160, 50 maybe. But there's a few weekly highs there and some lows there, and it goes back beyond as well. So that's my main area. Am I going to do anything up there? I'm not sure. I put another put yesterday, and that's going to expire today, probably worthless like the rest unless they do step in. So this is still danger city. The only thing that may be possible is that they really don't think that the level of the yen is a problem. Yes, it's been weakening. Yes, it's gained quite a lot, but they're looking at the economic impacts, and they may be saying, well, we're hearing from one side, like the airlines mentioned yesterday and the business lobby, but on the other side, it can be a positive. So I think they're weighing that in the balance. But certainly I think the market in general is getting more twitchy about intervention than they are, or the level that they are. So expect this to remain very choppy. We may see a big bit of profit taken into the weekend, just on the usual risk stuff. But for now, I'm still pretty much sitting on my hands with it and just watching it. What's your overall view, Kay?
Yeah. Well, that's what I said. I think there may be a bit of rate checking going on, then people, some trading stops being triggered, then people going into what if selling mode, and then it doesn't go lower, and then it comes back, and then we buy it all back again, and we're back to where we started. I'm not going to rule out the rate check thing because it is so that, and I speak out of experience, having been in banks for a long time, that a lot of, and I'm going to go in general, a lot of us traders have been slapped on our fingers because talking to press and things like that. I mean, every time in the past there was 100 pips move in the dollar yen to the side of which could hinder an intervention, the press was falling all over the banks and asking for comments, and people sometimes were commenting, and that's why those rate checking lines came into the press first of all, and then they called up the Bank of Japan, and most of the time the Bank of Japan would say no comment, but the day later they could have said like, oh yeah, we did rate checks yesterday. So this is not an intervention. I mean, I can for sure say that this is not an intervention. They would have kept it lower. You don't come in the market, sell $5 billion for pleasure, and then let it come back to your level. This is so counterproductive and a waste of money. So this is no intervention. Yeah, what do I do here? Nothing. I was quite lucky to be still a bit fresh and awake, and managed to grab a few pips in the process, but I'm back to flat, and I'm just running my put, see if they intervene. I'm starting to realize that I should have extended my put a little bit to the week after next. It expires on the 30th, but there's so much to do next week. But anyway, yeah, I've got levels in between, but the levels are very, I'm going to say perhaps psychological. There's a bit of a trend line I have coming in. I can show it, which is around one of 57.30 level in the dollar yen. All those yen crosses are above where they were before, and we have to look at historic levels if you really want to trade technical analysis. But if you go like trading one or the other, I don't know, pattern or so, it's so difficult to do because we just went down. We just went up 100 points after the Bank of Japan, 120. Then we went 170 lower, and then we now back 160 higher. I mean, good luck charting this on a short-term basis, right? I think really if you want to have positions, you do it on a 5-10 minute or something time frame, and then I'm gladly not even looking at my charts, to be honest. When I feel it, I may do something, or when I think like I may really go very, very tiny, let's say short, because I expect them to intervene after the PCE, for instance, but then it's going to be small enough that I'm not going to get hurt if it goes against me. And if it goes massive, if they do intervene and it goes 400, 500, 600 points, then even if it's like a tiny one, it's still going to make decent money. So that's more the approach that I have, rather than going to go, oh yeah, 157.30 is my trend line. I'm going short against a trend line because there is a trend line. That's a day like today, doesn't mean much, yeah. Really doesn't mean much at all.
Yeah.
But on the other hand, since I have my put running, and I think you have the same, although yours is a bit tighter in time, your expiry is sooner. But what I do have is that if they put it down, and so my put is at 152, which is already far away now. That's already a full intervention away. But if it goes below there, I will not refrain to buy, because I think that once the intervention is done, either they keep it there and I will have taken money on my put, or they take their offers away, and this thing flies again, and then I for sure will want to cover my put, because I think whatever they do now is a temporary is going to be a temporary plaster for as long as really Bank of Japan is not more cooperative, or we see JGB yields ramp above 1%. We are still below, by the way.
Yeah, yeah, very much so, mate. Patrick's asking about more concern with the Dixie. Is it not quite at the prior intervention level? I don't know. I'll show you what they look at. Okay, this is the Bank of Japan's daily FX report. Okay, this is their thing that they look at, the yen index of the previous day. Yesterday it was 78.02. The day before it was 78.24. Okay, so this is their measures. They're near the nominal effective exchange rate. This is the one we're below where they intervened last time. Okay, so this is like your yen index, and this is what the Bank of Japan produced. So that was 2 days ago, and as seen here, we're now at 77.79, and they produce this daily. So that's something they're going to be looking at closely, because it's the overall what's happening in the yen, not just dollar yen, all the yen as a whole, and that's where they decide what's weak, what's not as weak, and what's problematically weak. So that, I think, is what they look at more than the Dixie. Patrick, okay, you?
Yeah, absolutely. I mean, whatever happened, well, the thing is now, I think their sensitiveness has changed over the years. They used to look purely at the dollar yen because it was for a very simple reason that most of the dollar pairs were moving in tandem. Yeah, we saw moves on the crosses and things like that, but every intervention that they did was in dollar yen, which could still be the case, right? They could only intervene in the dollar yen because that's the main instrument, and that's also the biggest investment partner of Japan, right? Japan is I think they overtook China again. Is the biggest investor in the US. So de facto, their biggest investments are in the US. So that is what they will be looking and probably intervening in. But if you look at what happened on the yen, whatever is near the trade weighted index and everything, it's been collapsing even after reaching those lows from 2022. We are trading well below those levels right now, right? So and I think that's why Suzuki was so vocal for a long while. And actually, I'm going to say silence is a bit deafening right now. So perhaps it does mean that they want to surprise the market instead of continuing to blah 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 every day and every day twice. But I think they are very concerned about the overall level of the yen right now. So if you look at the Dixie, I think the yen is what, 7% or so in the Dixie. That doesn't matter for them. Where the euro dollar trades doesn't matter. The euro is 55% of the Dixie, so they don't care about that really.
I'm not bringing up the chart, mate. I'm not going to bring up the Dixie chart.
No,
make me do
absolutely not. Yeah. I mean, for our listeners, for our audience, we need to be in a very deep hole before we start to look at the Dixie in here.
Yeah. Michael's asking, with the yen at these levels and worried about intervention, it may make sense to buy back yen and sell Swiss for funding.
They still pay
I don't know. Let's look at a bit of context again. Okay, let's say you were selling yen at 152. Okay, we're now 156.63. Okay, if they intervene, and as we say, intervention can be 300, 400, maybe 500 pips, you're not going to be that far offside, even if they intervene now. So people who have been buying dollar yen here, they're not overly worried about intervention, unless they really smack it down, like cases, smack it down through 150 and put a bit of a line there for a while. You don't have to be worried if you're long from 152. You can be cautious if you get intervention, but you might just get knocked down to your entry price before it then rebounds and does what it usually does, which is recover everything it's done in the intervention. So from that aspect, if you're long from even further down and you're doing the funding thing, you're not fussed.
Ryan, Michael, I think he's talking the other way around, to buy yen and sell Swiss. Yeah, Michael, are you
Oh,
talking about buying yen or buying dollar yen and dollar Swiss? No, do you talk about the yen and the Swiss as a currency, right? Not the dollar pair. You're talking about the currency, right? Um, yeah, selling Swiss yen. Well, it's been a very popular play because that's the cheapest one, right? You pay away a lot less funding if you're short Swiss yen. The problem is, and then it's absolutely the opposite. And Ryan actually said exactly the right things. But if you're short Swiss yen, you're still going to pay away, even if it's like a lot less than if you short dollar yen. But does it make sense? It makes sense if you think they intervene and they keep dollar yen low. It will make sense. It's what I've been saying on the show as well. It's going to make a lot of sense if MOF comes in and says like, look, 150 dollar yen will not go above anymore for the foreseeable time. A little bit the opposite of what S&P did with the Euro Swiss. Then if they succeed to chase the speculators away, which is going to take a huge amount of dollars, or huge, well, yeah, let's call it dollar equivalent, a huge amount of dollars. But if they manage to scare the speculators away from the yen, then I do expect myself that the market is going to start concentrating on the second cheapest currency, and that's the Swiss. So I do this is a bit my case that I'm looking at now. I've been trading short Swiss for a long while, since the end of last year, basically. But I do think that there is a case for the bank, the MOF to scare the investors away, and then the market will concentrate on the second one, and that could then send the Swiss a fair bit lower, but not before we get the correction in sympathy with the dollar yen, and that's all assuming we get this intervention. I think if MOF intervenes in a meaningful way, we should see Euro Swiss and dollar Swiss first of all go lower, okay? Because all the dollar pairs will be affected for a while, for the time of the intervention, and then the market will reassess. That is kind of my base plan right now.
and, well, unless they get the ECB to do some of their dirty work, and then they might
Oh my God.
bow into other Euro, like buy other Euro pairs and crosses, which in
Yeah,
case
this
Euro
is
Swiss
going to
might
be a
go up.
mess.
So it's yeah, it's still we don't intervention. We don't know what intervention will bring for other pairs and other things. If it's just a straight Bank of Japan thing, that's pretty more contained. If it's a joint thing, getting other CBs to do a bit as well, then that's going to affect pairs in different ways. So until we actually get
Exactly.
it, unfortunately, we're not going to know how it's going to turn out. So you can't just say, "Oh, they're intervening. I'm going to sell euro dollar because they're intervening,"
Oh,
just
please
in
don't.
case the ECB are doing that and they liquidate selling euro yen by buying euro dollar.
Yeah.
It's just a mess at the moment to trade. Very much a mess at the moment to trade, and I'm largely sitting on my hands doing it because it's just too much risk for me. I don't need that in my trading account. So, I don't mind. If I miss a big intervention, it's 500 pips. I don't care. I'll still be
Mm.
trading markets tomorrow and the day after.
No, absolutely right. Look, I've lived the ECB intervention for the Bank of Japan, and it's a big mess. And I can tell you, I was dollar yen trader, right? I was the dollar yen market maker. I can tell you, my colleagues tried to sell euro dollar, because we got hit in euro yen by the ECB, and I tell you what, they were looking at quite a hole at the afternoon, because they called ECB on the back of it. They called up their the German main bank, not to name them, to buy all the euro dollar back, because the Bank of Japan only wanted to sell dollar yen. And I tell you what, that was one mess in the euro dollar that day, a big
Yeah,
one.
well, that's their cross to bear. And yeah, I traded a couple of interventions in 2011, 2012, that period when the earthquake, just before the Abe's arrows came shooting across our skies. But yeah, we still just don't know what it's going to look like if and when they do it. Right, but anyway, there are other things to look at, other assets. But again, it's hard to draw any real conclusions from some of these moves because, as we say, what could happen with intervention and what could happen with this. I'm surprised to see euro a bit higher. Kay, you had the thoughts yesterday that maybe it's a bit of squaring off of positions and whatnot. You know, given the data yesterday, the dollar's a little bit weaker this morning, but we could be facing another flip flop if this data's strong this afternoon in the US, and then we're going to move into the orbit of the FOMC. So that's going to start raising some questions. So I'm loath to say, is this price justified? But is it something we can hang our hats on?
We can hang our hats on. Yeah, I thought this kind of scenario may happen, and then, but again, we'll have to see what happens. I think if they don't intervene, and we got the PCE as expected, or after the data that we had to work with, even seeing a little bit stickier, I think for the month end the dollar may reverse a little bit from where we are now. Take away interventions, I would say the dollar could end the month a bit stronger from here.
Yeah,
because I think most of the people are still in this mode. We have to say that a lot of this market is now a spectator of what's going to happen in the end, right? So, and I think a lot of traders or people who are not long-term traders, short-term traders would have said that, well, in case they intervene, I don't want to be too long dollars because we don't know what's going to happen. So, but if everything remains quiet, let's say, on the yen, then yeah, I expect the dollar to regain a little bit of its forte into the month end.
Yeah. So I mean, you know, as much as we're cautious about trading at the moment, it doesn't mean you don't have to not trade. We have to not trade, you know, but pick your levels, pick your spots where, you know, you might be happy doing a trade. You know, I tend to look at the stronger levels. We know 108 up into 108 is a strong area. We've had all this action before. We know my old zone 108, 30, 70. So if you want to be trading, look at your big levels. You know, 107, it's a little bit wishy-washy at the moment. It was a big level before. If we go to 110, it'll be a big level again if we come back. But right now it's a little bit hopeless. So you know 106 is a level because that's as far as we were happy to fall in that move there from the 108. So that's a decent level. So if you're going to have a go at these things, you know, watch out your short-term techs all in here because you're at risk of the high volatility that we've got at the moment, and mainly due to the end. So if PC data is a bit soft and we get up to up to the 108 level, and you know that's where we struggle, then that's maybe where you trade it, rather than trying to trade it in here in the middle of all this noise. So the market's going to be sitting, waiting for intervention and waiting for this PCE data, and then we're going to get a move. And I think, again, as we often say, where we finish the week is maybe going to be the most important thing to take from this. Also, look for a bit of profit taking or a bit of risk reduction because we've still got this Israel thing going on, although we've heard no more hostile words between them and Iran. I still think the market's maybe going to just keep that in the back of the mind when it comes to risk positions going into a weekend. We've got this potential Rafah offensive going on as well, which might get a few heated comments coming about. So that's also something to consider in the latter part of today. Ali, you're dibbing around in Euro Sterling, I see. Again, it's not doing an awful lot. We're in the middle. So it's nothing for me here. If we get a dip back towards the low 85s, I'm going to look to add back into my longs and then take profits on any rallies again. But yeah, we're just messing around this 70-80 level now. So it's not really deciding what it wants to do, whether it wants to bounce back or head lower. There is no fundamentals at play right now today between the UK and Europe. So this is going to be moving on the speed difference between cable and euro dollar. So that's going to drive the move. So that's more of an artificial move rather than a fundamental move. So if you're trading this one, you got your levels, mate. So good luck with that. And yeah, hope you make money on that. Kay, is there anything tickling your fancy today? I mean, gold had a little bit of a rally yesterday, but we're not. It's looking a bit dead cattish. It's not looking like it really wants to have a run back towards these highs. But neither is it going down again or still. So, bit of consolidation, you think?
Yeah, but we have to note that we are back above that 23, 2025, and had a look below. It does look like we're still seeing those buyers on deep. I thought honestly, with the Middle East situation calming down, and with US yields going up, I don't have a position, but that there was a possibility for it to come lower, and I was actually hoping a little bit that it would drag silver lower as well to re-enter pieces of what I've sold the other day. But no, we are not getting it. So that is still telling us that gold at least stabilize here and may not even be done. To the top side. No, for the rest, I'm just yeah, Frederick. No, we haven't covered dollar mix. But if the question is that if we covered the positions that we have in mix, yes, but we have not covered it. We haven't talked about mix today. So what was what was your question? If we covered our positions or if we covered it on our show? And yes, Angela, a very good observation on the show. A very good observation. We're trading value data end of month, by the way. It has not had a big impact of late from the US corporate side, but I'd say we can't rule it out. Perhaps a bit of US corporate activity, but everything will be centered around how this PCE comes out today, and if we get any potential interventions from the Bank of Japan, of course, that's going to be the main concern for this market.
Yeah, thanks, mate. Dollar MEX, it does look interesting actually, because we had this 1740 level, and we had that obviously that big spike through it, and then we had an immediate hold after. And I think I said when the day after we had this is important because this shows you that this is a whatever type of move, low liquidity, dodgy time of night. It's where levels show up again thereafter. And so it's shown up twice now since we had that spike. So this is, whatever this move is, when we've got back to normal markets, this has become a level once again. This is where we're really trading it. So this one still looks like it's pretty bullish and wants to creep higher. We've got some decent levels here, but it's got a long way to go before it really starts turning around this trend. I haven't even got a fib in it yet from here to here, because that's probably not until about 20 odd or something.
No, 18 and a half.
It's what, sorry?
I think 18 and a half is the magic
18 and a half, is it? Yeah, which is bang on another big level that we're going to take care of. So let us know what you're doing with that yourself, Frederick. Are you long, short? What are you playing with it? And then we can have a look at that in more detail. Right, just last one then, and I think we'll call it a day. It's been a long week again. Just looking at stocks that got a real smacking over that GDP data. That's one of the markets that really did get a spanking. But look, we've come all the way back to these highs. 51 is building up again as the level we need to watch on the top side here. So again, base what your market closes on this. If we close today above 51, then maybe we are going to go back to the highs, and we've had our pullback rather than a collapse in stocks. But yeah, that was a really big pullback that we saw yesterday. So we're looking a bit more bullish still on that front. Right, on that note, I think we will call it a week. Thank you everybody for coming to the Flow Show and following us this week and other weeks. I hope we've done a good job for you here. I know K-Man has, certainly for me and the other folks in the chat room. So thank you very much, Mr. K.
Thank you, Ryan. Thanks everybody for being with us every day. We really appreciate you. And don't forget, you may not make your monthly profit on a Friday afternoon, but you could lose it if you do anything stupid. So please, no horror stories on Monday morning, okay?
Wise words indeed, mate. Thank you, everybody. Have a great weekend, and we will see you all on Monday.